Well, good morning if you are watching this recording in the morning, and good afternoon to those of you who are watching in the afternoon. I am so excited to have you join for our brief but hopefully impactful conversation today as we talk about one of the hot words as a part of the beginning of this year. And really, we've been talking about this word for the last year or so. I am recording this as we're starting to see some snowfall here at the office in Raleigh, North Carolina. So we may see some snowmen and some snow angels start to pop up sooner rather than later, depending on how hard we get hit. If I haven't had the opportunity to meet you yet, or this is your first webinar with us at TradeWinds, my name is Miller Hoffman. I lead our client experience team, which involves me doing a lot of these webinars that are largely educational. And we keep a lot of them online. So if you haven't checked out some of our previous webinars, ranging from status in the economy or state of the economy, politics, along with a handful of other topics that we either write on, and occasionally we will do these video webinars too. Today is going to be very focused on the tariff side of things. Like I mentioned before, it's on many people's minds, especially from the financial element. Not just at the economy, aggregate economy level, but also for us as individuals and participants here in the economy in the United States. In typical TradeWinds fashion, we run towards these topics that can be tough to discuss at times, especially when there is a lot of uncertainty that is still in the picture, along with the natural political climate. Right? Love it, hate it, or indifferent, this is where we are. So on the TradeWinds side, we try to cut through a lot of the noise, give you the information you need to know to feel more comfortable, or at least put things in perspective. So I'm hoping today, and the handful of slides that I have to discuss with you will be helpful. And as always, this can be a start of the conversation that we invite you to have with us. So once again, thanks so much for tuning in. I appreciate your attention up to this point. We will keep it short and to the point today, but wanted to discuss, again, a topic that's pretty politically charged at this point in time, but adding some perspective is super important. With that, let's kick things off. This is the you may already know this, but slide from a lot of the articles, a lot of the news media, social media, at least my feeds tend to be popping up with a lot of armchair economists over the past couple weeks, and certainly the last couple months. But let's start kind of at the elementary level and let's build on top for today's purposes. Let's start with just what is a tariff and clear up some common misconceptions that you may have heard friends, family members, and even newscasters mention. A tariff is basically a tax imposed on goods that are coming into the United States. Despite popular belief, the tax is paid by the importer. So that would be, in our context, the U.S. business is the one paying the import. We commonly hear that the tariffs against X country or maybe a particular industry, while there is some indirect correlation to that, that's not exactly the truth. When we talk about imposing tariffs on different countries, different products, different goods, really we're talking about American businesses being the ones paying said tax or said tariff on goods that we are importing. For those of you who watched the previous webinar, I used a lemonade stand as an example, right? Three main goods. We have water, we have lemons, and we have sugar from a variety of countries. We're getting our water from France, we're getting our sugar from Brazil, and of course, we're getting those wonderful lemons from Spain. As we pay to import these goods in, any tariff that's in place against that particular country, let's take Spain, for instance, and our lemons, our lemonade stand is actually paying the tariff, not Spain or not the Spanish company that we are buying said lemons from. This is why it tends to make the imported goods more expensive, right? Our cost of doing business has now gone up. Typically by a percentage amount. So you may have heard the Trump administration express tariffs in terms of percentages. We're going to raise 10, 20, 25, upwards of 50, even higher percentage points on particular countries, which we're going to dive into in just a bit here, along with particular goods or different markets that provide, again, goods and services to us here in the United States. We're going to talk about on the next slide some of the pros and cons, but something that the Trump administration is very interested in is trying to protect domestic businesses, along with creating other forms of revenue to help offset the spending and the deficit and the debt where we find ourselves in as a country, along with proposed tax cuts. Remember, less tax revenue or tax cuts for you and I, the persons watching this webinar, means less government, or excuse me, less revenue for the government. We're going to have to find other ways to raise revenue, and that's kind of the one-two punch that the Trump administration is looking for at this point. I think if I were to speak on their behalf or project myself onto them, it would be, hey, if we're going to cut taxes, we have to find a way to offset that. And if we can try to right what we believe are previous wrongs or previous lopsided trade deals, even better. Let's dive into some more of the pros and cons, though. Like with any political topic, the truth is there are some pros or some upsides, but there can also be some pretty pricey downsides as well. Let's walk through these here quickly. Pros, like I just mentioned, it's a protection of domestic industries, keeping jobs at home, keeping American businesses thriving. The truth of the matter is a lot of other countries are able to make products and goods much more inexpensive than we can here in the United States. Now, we can debate on why that is, from employment norms to the age of the workforce to the working conditions and the rights of said workers. At least for today, we're going to stick on the topic of tariffs. And the truth is, other countries are able to make a lot of other goods much cheaper than we can. There's also a national security and a privacy aspect to this, right? What kinds of goods are coming into the country and what kind of data or information are they taking from the American citizen, right? We live in an artificial intelligence and a data world where that is one of the more expensive forms of data to get. Where are consumers' attention and how do we best capture and capitalize on that? We talked about a source of governmental revenue before. If we are expected to see the Tax Cuts and Jobs Act hang around and maybe even change in terms of more tax cuts or more tax breaks, we're going to have to find another way to replace that or at least offset what that impact would be. I think the more important one, and at least how the Trump administration appears to be approaching this, is money tends to be the universal language. Nothing gets your point across quite the same way as either adding or taking money away. The Trump administration has been very bullish in terms of using this as a way to bring countries to the negotiation table. We've seen that occur over the last month or so with a lot of the negotiations with Canada and Mexico, specifically when it comes to immigration policies and the drug approach that the Trump administration is adamant on focusing on. We will naturally see ways that this manifests itself in different ways. What else is the Trump administration looking to leverage? And how can our relationships with other countries either pay for that or once again offset maybe some of the negative facts? That would be the pro case, the in favor case for you. There are also some market cons or some downsides that would be important for us to point out. Virtually any economist out there is going to say tariffs negatively impact the general economy as we see it to be inflationary, right? The price of goods increase because American businesses, their cost of goods sold and the cost that it takes for them to import these goods. Remember our lemonade stand, we're going to pay more for that lemon than we were this time last year. Ultimately, this trickles down to consumers paying for it. Naturally, that is one of the more flags or the banners that are being waved at this point is consumers need to be expecting a higher cost at the grocery store and in other ways where you participate with your dollar. Can also affect the integrity of the business. So seeing this pressure on employment, right? If our costs are going up for the goods, if we keep our top line or that revenue number constant, we're going to have to make cuts in some other element. Oftentimes employment, that looks like layoffs, comes into effect too. See 2018 for the retaliation bullet point here. We'll talk more about China and our relationship with them and a handful of the other countries where we mostly do our business with. But retaliation, right? We're already seeing other countries coming out and kind of preemptively saying, here's what we're going to do if this happens, we will naturally see the stakes get higher and higher, would be my assumption. That is my projection here. We'll see what happens moving forward. But that's a potential con, right? We're disrupting some of the current deals that we have in place with important countries that we have that really stimulate our economy and keep things moving the way that we are expecting. So main takeaway on this page, guys, as much cons and pros are out there, I would push you to have an open mind. If you're in the con here, we're not loving what Trump is doing, be open-minded to what some of the pros look like. I find that that puts it in a bit better context of why is Trump and his administration behaving the way that they are, and vice versa. If you are in the pro, be open to what some of the short-term or potential long-term cons could look like. These moves that the Trump administration is looking to make are not without the natural cause and effect that we'll naturally see with really any step that a particular party or administration looks to make. To keep things moving along here, let me point out the U.S., our largest trading partners. At least it seems like to me, and this is my bias, a lot of our stuff comes from China. While that is true, actually Canada and Mexico are some of the more popular trading partners that we have as we speak, or at least over the last couple of years. We've seen China actually drop down to number 3 by a lot of metrics. A lot of that is just from a relative position. Canada and Mexico are closer to us, and Mexico has actually been very competitive on what pricing looks like for some of their goods. They don't have to pay to ship it across the Pacific, which naturally brings its own issues with it along the way. I've included here towards the middle of the page what the rough deficit looks like. So if you didn't attend our previous webinar, I encourage you to go look for it and watch it. The SparkNotes version is we are in a trading deficit. That basically means we export more than we bring in. So this is something that we need to be careful of as consumers. How much are we looking to bring in versus pushing out? This is a core component to GDP, which is why I included this scoreboard here in front of us, right? The Trump administration is very sensitive to the economy, to the stock markets, to the bond markets. I think he may be considered one of the most sensitive presidents to how the economy actually is performing. Will be interesting to watch over the rest of his administration. Along with pointing out, if you want to see a short film on how this worked out, look at the tail end of 2018. For those of you who recall, this is really when Trump did a lot of his beta testing with tariffs and putting more economic pressure on China in particular. Stock markets did not love that. We saw it drop pretty drastically towards the last quarter of 2018. And actually 2019, we saw the bounce back as some adjustments were made. Is that the tail that we're going to see in this administration, kind of the Trump 2.0? Or will we just see more of the same with some subtle differences that make up the difference? Only time will tell. But pointing out our largest trading partners really translates to why. Why is Trump picking on a handful of these countries? More so from a size perspective. Overwhelmingly, we do most of our business with Canada and Mexico and China. Why is the Trump administration looking to use tariff as a tool to really get what we're looking for from an American interest perspective? I mentioned this in the previous webinar, and I will reiterate. Trump is the president of the United States. He's not the ambassador of free trade and capitalism. While we tend to think those two things go together, right? He's leading one of the most capitalistic, if not the most capitalistic country in the world. He's also looking to protect American interest along the way. That doesn't mean you have to agree with the methods in which he's going about that. But again, this is flying kind of directly in the face of what a lot of economists would say is not good for the economy or not good with stimulating trade amongst different countries. Here's why he's going after a handful of these countries, though. I'm including this graph, percentage of GDP. Remember, GDP is a measure of how well a country is doing, how much are they worth, and we naturally track that over time to see how well they're growing or maybe lack thereof. Trump is using tariffs to try to pinpoint a soft underbelly, especially for Canada and Mexico. A large portion of their country's performance is made up of trading agreements, specifically with us, the United States. China, not so much, but I included the United States and what our percentage of our GDP, how much is that made up or could be attributed to the goods and services that we trade back and forth with a variety of our trading partners. Ultimately, main takeaway here, guys, is Canada and Mexico are much more dependent on their relationships with us as from an economic perspective than we are with them. That does not mean we do not rely on them. Remember, we still have a good about a quarter or so of our economy is based on our relationships with other countries, specifically from a trading perspective. Those numbers just drastically increase, specifically when we take a look at Canada and Mexico. Again, you don't have to agree with and love Trump's policy, but I think this helps put things a bit more in perspective when we talk about bringing other countries and the leadership of said countries to the table to best represent American interest. You will notice industries here most affected are largely good based. There's a physical, tangible item that we are trading or getting something in between, whether it's a piece of wood, lumber wise, steel and aluminum, farming, the said crop, and the natural shipping that we have, getting our product to them or vice versa. So be on the lookout for a lot of these industries being more sensitive, perhaps, than others. Leading me to the last point, how will it affect me? Let's be selfish for a second. What does this mean? The Trump administration's moves, what can we do? And how should we temper our expectations, not just for the next couple quarters, but if these things hang around a little longer than anticipated, how do we make sure our expectations are adjusted as a result? All the way here in the purple, this is more personal. Tariffs lead to inflation, and inflation being stickier than expected. This is a bit different than what the Trump administration was really strong on campaigning, right? Inflation was definitely an issue during the Biden administration. A lot of promises were made that the Trump administration would really focus on inflation, keeping it low or even dropping it lower than it is now. Tariffs are not the best way to go about that, at least from a historical perspective. Remember, tariffs have been around for hundreds, literally hundreds of years. In fact, one of the biggest pieces of legislation during George Washington's term was instituting tariffs to help protect American industry as we were trying to get ourselves started as a country in the first place. This looks like incorporating changes into your budget. Right? How much do we normally spend on A, B, and C? Let's expect for those costs to go up, whether it be temporary or stickier than expected. I think that's a reasonable expectation for us to consider. For my small business owners or self-employed folks, depending on your industry, you could really expect to see this roller coaster continue, especially if your industry is more goods focused. Are you buying and selling tangible items, or do you largely work in a service-based industry? While services aren't completely exempt from this, can still have definitely some relationship with it too, but we tend to see more so goods based. Remember, previous slide here, more lumber, steel, farming. A lot of this can be tied to whatever industry that you're working in. And bounce back. And then from a market perspective would be this yellow portion. Look, some investments are going to be impacted more than others. We'll naturally see the headlines reflect this, how our technology or media companies will be affected versus the John Deeres of the world, the companies actually making, again, a physical product that they look to trade with other countries around us, along with naturally as we import the raw materials that it makes or takes for us to put these types of goods and services into effect. Successful companies, the ones that stay around and expect to be around in the future, will naturally plan around this, which naturally looks like increasing the cost for said product or service. So kind of gets at the circle of life here is certainly true, right? If we see companies, successful companies increase prices as a result of the tariffs, remember the tax that they are paying to import these goods, expect that to wind up and hit your bottom line. I think that's the safest expectation that we can make, especially if I'm being conservative, right? What's the worst case scenario that can happen? This is just the beginning of the conversation. We aim for this to be 15, 20 minutes. So if you have further questions or concerns, be more than glad to chat with you. Come on in the office. We can jump on a phone call, a video chat as well. This is an evolving landscape. We are naturally going to see this change. We're going to see the Trump administration pivot one way or another. We're going to see different countries result or react as a result. So let's make sure we keep our heads about us, make good decisions when it comes to your financial position. And of course, your investment portfolio and financial plan is a part of that. Feel free to reach out to me as you have questions or concerns. But thanks for joining the Tariff Talk with me here this morning. You have a great rest of your day. Thanks. Bye.